So in this video, we're going to start to learn the factors that determine the money supply. So actually, based on the previous video, we already learned a lot of factors. So basically, for this lecture, we just try to summarize, put everything together to understand what are the key factors that are going to affect the money supply. So generally speaking, if any action the bank going to take will allow them to increasing their money base, such as the checkable deposit, it will increasing the money supply to the country. So first of all, like I said, we talk about anything can increasing the liability of the banks, and that will help increasing the monetary supply. So what are affecting the the deposits for the bank? So that actually including two components. So one is non-borrowed monetary base, another is the borrowed reserve. So any of those, the non-borrowed monetary base goes up, or the borrowed reserve goes up. So that will all increasing the money supply. So money supply. And so that's one thing we learned from the previous lecture. And what is another? So we noticed that the required reserve ratio, so like the 10% in the previous example, a previous lecture. So the required reserve ratio, that's limited the amount of money, the reserve the bank can lend out to the society. So which means that limited amount of the checkable deposit can be showing up in their T account as a liability. So if that's the case, so the higher required reserve ratio, the more likely the bank, the lower amount of money the bank can lend it out. So therefore, that will stop reducing the money supply in society. So the money supply is negatively related to the required reserve ratio. So now you are thinking, why the Federal Reserve set up higher required reserve ratio, and why? Because they want to keep the security of the bank. So that's what happened during the 2007-2009 financial crisis. So the bank doesn't have the Federal Reserve didn't set up a higher enough required reserve ratio. So the bank basically lent out a lot of money. So when we had that banking system crisis, so the individual went back to the bank to withdraw the cash, they won't have enough cash. So if the bank do have enough required reserve sitting in the bank, when people come to the bank to withdraw the money, so they know they can get the money out. So that's when the people don't realize they won't be able to get money out, that's freak out more and more people, and more people rush to the bank to withdraw money. And so that's creating the banking system crisis. So this kind of required reserve ratio have meaning, although it's negatively affecting the money supply, it definitely keeping the health of the banking system. So the second factor is called the currency holdings. So we explained in the previous lecture that if individual withdraw after they getting the checkable deposit, if they just get it as a currency, never use it, just put it under their pillow. So what happened is that's reducing the chance for that currency going back to the banking system. So basically, once those money ending as a currency and holding by the individuals, so that part of money losing the opportunity to creating more monies. So therefore, the money supply is negatively related to the currency holdings. And the last one is called excessive reserve. So the money supply is negatively related to the amount of excessive reserve. So what is the excessive reserve? Like I said before, some banks try to be very, very secure. So beside the required reserve, following the required reserve requirements, so like 10% of money has to be stay in the bank. So they try to be very, very safe. So they might decide to keep 12% as the reserve ratio instead of just 10. So therefore, they have less money to lend it out. So therefore, the money supply will be relatively decreased. So therefore, the money supply is negatively related to the amount of the excessive reserve. So to summarize what we learned, so if for the Federal Reserve System, if they are increasing the non-borrowed money base, so that will increase in the money supply. And so for the player, the commercial banks, and if they are increasing their required reserve ratio, and the money supply will decrease. However, if they increase the borrowed reserve, and why we put the banks as the player for the borrowed reserve, because they are the one initiate the borrowing from the Federal Reserve. Remember, the borrowed reserve is the bank borrow money from the Fed. So if they're increasing the borrowed reserve, so the money supply will goes up as well. So for the bank, if they decide to keep more money in their bank instead of lend it out, they consider as excessive reserve. If they are increasing the excessive reserve, so the money supply will decrease. So lastly, for the depositor, like every individual, for us, if we have the money in hand, if we don't use it, we don't deposit, and so those money basically is sitting under our pillow or in our wallet, we never use it. So if the amount of those currency holding increase, that's actually going to decrease the money supply. So understanding what are the factors affecting money supply will allow the Federal Reserve and individual to understand how the money are going to be supplied in the whole banking system. And so like we said before, at certain situation, we do need more money. For instance, like current situation, when COVID-19 happening, everybody need the money to pay their bills. And so therefore people need the cash. And so how are you going to get those money to allow those people to be able to afford the houses, to be able to afford the mortgages and affording the daily and the money they need to buy the food. So they need to increase the money supply. So do you think the Federal Reserve just issuing a bunch of money? Maybe not, because that might potentially causing the inflation, and also those money might not be able to really get it back. So what the Federal Reserve usually do is the Federal Reserve will using the method we learned, like open market operation, and try to increasing the non-borrowed monetary base. And so the reason they do that, because they know the operation on the area the Federal Reserve can directly control to increase the non-borrowed money base. So they cannot they can also lower the required reserve ratio, but that's nothing we want to do now, because usually when you lower the required reserve ratio, it takes a really long time to see this actual money supply in the market. So the direct impact, the instant money supply will happening when the Federal Reserve tap on the non-borrowed monetary base. So that's basically what happened for the Federal Reserve. So they are start to buying more bond, so that allow the bank to borrow lending more monies, and so that is how they creating the more money to the market. So again, why we are not need to know those factors, because in the future, if you become part of the policymaker, you have to understand, in order to have this effect, what is the treatment, right? So you have to know what are the factors affecting money supply. And so in our next video, we're going to look at some mathematical formulas that allow us to understand how to really accurately calculating the money supply. So which means we're going to look at a money multiplier. Although you learned that from the principal macroeconomic class, so in this class, we're going to look at a relatively more complicated model that allow us to be able to more accurately to forecasting how much money you're going to supply on the market.